if you're thinking about selling your home and you've been in your home for at least 2 years, you're in luck. When you sell a primary resident, you have a capital gain exemption, right? So whenever you buy anything, whether it's stock or home or collectible, and you sell it, there is a tax on the profit that you'll be making. And we have short-term tax, short-term gain, and we have long-term gain, and both are taxed at different rates. So if you just bought your home and then you sell within a year, whatever profit you make, chance is pretty low, but if you do make a profit, you are taxed at the short-term rate, which is significantly high. However, if you hold a property for at least 1 year, so it needs to be 1 year plus 1 day, then you qualify for the long-term capital gain. And that is a lower tax rate. Typically, somewhere between 10, 15, 20% for federal, and then 10% flat for California. How do we get around to being able to avoid this tax? Well, you need to live in your home for 2 years. If you live in your home for 2 years, then you qualify to deduct up to $500,000 for a married filing joint. So let's say if you're single and you own the home and you sell it, then you qualify to deduct $250,000 in profit. So let's say you sell a home, you bought it for $1 million, you sold it for $1,300,000, let's just say. And for sake of simple math, it costs you $50,000 to sell this home, all the costs. So now your gain is $250,000. When you go to file your tax return, all that $250,000 will be tax-free, assuming you live in that home for 2 years. And if you bought a home with a spouse, then you have up to $500,000 of profit or gain that you can deduct without having to pay taxes. So then for those who've been in their home longer, right? Maybe 5, 6, 10, 20, 30, some are original homeowner. And the Bay Area has a lot of original homeowner. And the typical turnover rate for home here is give or take about 10 to 12 years. So the home has a good 10 years to gain equity, to appreciate over that period. And most of them going to gain more than 500,000. So when you in that situation, then anything that is over what the capital gain exemption is going to be taxed at the long-term capital gain rate. And usually I tell my client estimate about 35% or 38% just to be on the safe side. And you're like, Thuy, but capital gain is only 20%. Well, for federal, it is up to 20%. And hey, every year it does change. Typically it is 10 to 20%. You also need to consider California tax, because California will always want their money as well. And California is roughly about 10 to 11%. Together, you're already looking at 30. And then you also have another investment gain that is about 4%. So I always say estimate 35 to 38% to be on the safe side. You better to be conservative than to estimate less, and then you end up with a lower number. There you go. How do we take this capital gain tax code and take the most advantage out of it? Well, if you're willing to move regularly, you definitely can do that. So I would say buy a home, live in it for 2 years, sell it. Then you can take advantage of that gain, buy another home and do it again. Because there is no limit on how many times you can take advantage of this capital gain exemption. So you do that, let's say in a span, let's say rather than living in your home for 10 years, and at the end of 10 years selling it, you're going to end up having to pay capital gain. But if you're willing to move, and if you just buy a home every 2 years, sell it, take that gain right there, all that money, buy another one, again, live in another 2 years, sell it, then, within that 10-year frame, you're going to have it completely tax-free. So that is how you take advantage of it. As a homeowner, I definitely have personal experience on how, owning real estate can really help you financially. And when you own a home, you get to deduct a lot, right? When you're renting, there is no deduction. When you own, your mortgage interest rate, you get to deduct. Your property tax, you get to deduct. And it really depends on your income level If you do make too much, there is a cap on that tax that you can deduct. However, it's better to be able to deduct than not. And let's say if you are a 1099, not employee, if you are a 1099 contractor, even better. Now the window is open for you. Now you can claim home office if you have a home office. Don't claim if you don't have it, right? If you use your car to for your 1099 business, you can definitely claim that. There's a lot of expenses that you can definitely claim when you're 1099 and having a home. And if you have a home office, then you can deduct quite a bit of expenses of your home office into your tax return. And every little bit helps, guys. I feel in terms of owning a home, the greatest and most benefit of it is there's really two things. Number one is the appreciation. You're living in a home. This is your investment. You have to have a place to live anyway. So while you're living in it, your monthly mortgage is capped because when you're in your 30-year fixed rate, that's it. You can't raise the payment on you. During this period that you live in it, every year your home is increasing in value. And typically home in the Bay Area, we're looking at minimum 7 to 20%, depending on where you live. The better the area, the higher the appreciation rate. And of course, the higher the cost as well for that home. And there is a reason why, right? Because it does appreciate more. You have more safety. It's a better community, better school, things like that. On top of that, what I see in my experience right now is that a lot of retirees who had bought their home 20, 30 years ago, where they were just starting a family or raising a family, now they have this huge equity in the home where they can take it and move anywhere across the country, whether you're going to Sacramento, where you're going outgrow, or even certain area. A home is only about $450,000. You're getting a brand new, beautiful home. Whereas here, average San Jose is 1.7 million. And I can tell you in the next few years, we're going to hit 2 million very fast. If you are thinking about buying a home, you better get in before it hit 2 million. You can start gaining that appreciation. And in the future, however it may be, when you decide to move away or even downside, because there are townhouse and certain community that is geared toward, I would say, 55 plus. Those community is on a lower price point, so you can still take advantage of that. Check the equity out, move into a smaller home that's going to be better fit for a different phase in your life, and be able to check that equity out, enjoy life, do whatever that you want to do.